But let's move on and let's shift focus to PNB Housing Finance. The ratings have been upgraded, remember, to AA plus from AA by CARE Ratings with a stable outlook from positive. To discuss this and more on the FY25 outlook, we have Girish Kosgi, the MD and CEO of PNB Housing Finance, joining us. Girish, always good speaking to you. Haven't spoken in a while, so thanks for joining in. We want to talk a little bit about this rating upgrade. How does this impact your cost of funds? What is the incremental cost of funds now versus, what the average cost of funds are? If you can just take us through how this would impact your business.
Good morning, Sonia. I think this rating upgrade was long due, and now 3 out of 4 agencies have upgraded from AA to AA plus. I think rating upgrade is a reflection of a lot of improvement on financial metrics in last 4 to 6 quarters. Just to give you a context, PNB Housing is in a transformational stage, and this is in 2 phases. Phase 1, obviously, we had to deal with stabilizing corporate book, improving asset quality, get back growth and capital raise, and also be future ready in terms of opening branch network so that we are ready for the current financial year onwards to scale up in terms of growth and profitability. So this rating upgrade will definitely help us to reduce the cost of funds, and it will help us to position the company better going forward.
Okay. When you say transformational growth lined up for PNB Housing, can you just quantify that for us? Because, if you look at your performance, right, your disbursements are not translating into any meaningful AUM growth for the business. So can you tell us, when you talk about transformational growth, what are you looking at in terms of AUM growth? What is the opportunity for PNB Housing?
I cannot talk much about Q4 and the financial year FY24 because we are in silent period. But if you have to look at the growth, which used to be about, let's say, a year back, it was almost on retail especially. It used to be flattish, and now we are talking about double-digit growth. And generally, if you see, Q4 is a very strong quarter for NBFCs and HFCs. And I'm sure the industry is going to do well. Most of the companies in Q4 will do well. So in terms of PNB Housing, as I mentioned, we raised capital. Retail growth was pretty healthy. At the same time, we also moved segments. And now we have also opened 100 branches in last 4 months, that is from December to March. So now we have 300 branches. Out of 300 branches, 100 branches are going to start operation from this financial year, which will propel us to growth and profitably because the branch additions have been largely on affordable. So now affordable branch count is about 160, which was about 100 4 months back. Now it is 160. We have started a new vertical called as emerging markets that also will take shape from April of this year. And of course, the balance 90 branches would focus on prime. So out of 300, 160 would be in affordable, 50 branches would focus on emerging, and the balance 90 branches would focus on prime. So this would definitely help us in terms of growing faster.
All right, Mr. Kosgi, good morning and good to see you. And Nigel on this side, with regard to the rating upgrade, you're sounding quite enthused. I'm looking at a Motilal report and they are indicating that the cost of funds could come down by around 20 to 25 basis points. Is that more or less in line, ballpark?
I would not want to comment on any reports, but I think because of the rating upgrade, not just rating upgrade, because rating upgrade is result of many financial metrics improving. So we definitely foresee reduction in cost of funds, could be 15-20 bips in the next few quarters.
All right. Got that. Yeah, so good to get that number. Mr. Kosgi, hi, morning, Prashant here. Let's just talk about your affordable book, sir. We've spoken about this in the past as well. You've told us that, about 20% of your sales comes from builders and high rises. Rest is plot sales, sort of resales, etc. How's it doing, that book? The bulk of the financiers, and I think we've had this chat before as well, and I asked you, on the affordable side, supply seems to be the problem. That is the feedback, because everybody wants to do luxury. On the affordable side, there's not that much. You've managed to grow the book in a very fast-paced way, very quickly. Can you tell us, if you're finding enough opportunities, just some qualitative comments, what's happening there?
Yeah, I think for us, affordable business was a great story. We started that business about 15 months back. So in first 10 months, we crossed AUM of 1,000 crores. And by March, I think we have grown very, very well. So I can't share the numbers as I mentioned to you, but I think it's been a great story on the affordable side. And very shortly, I think we will be crossing AUM of 2,000 crores. I think that has been the story. And in next couple of years, we should be a very, very dominant player on the affordable space in the industry.
So it's about, you're doing about 100 crores a month? I mean, that's the run rate?
No, I
On
think
the
we have peaked close to 300 crores per month.
Sorry,
Of course, that's
okay.
the peak. If you talk about average, it will be about 200 plus.
About 200 crores plus a month. And there are no issues there, right, sir, on that book? I mean, it's all safe and sound.
Yeah, book
because
is very good. However, for us, it's a very, the book has been built in last 15 months. Book is very good. Early warning signals are pretty, comfortable and encouraging. But I think given the context of the product per se being mortgage, we don't see any significant risk. Risk will be in line with the industry.
are you in that segment? Are you growing faster than the industry? I mean, there is some concern from a few analysts that maybe the book is growing too fast, maybe a little out of sync with what the rest of the industry on the affordable side is doing. Would you look at it that way?
So I mentioned this before. I think scaling up of affordable book comes in three parts. One is how strong the process is, and are we opening enough number of branches to grow, or are we growing from the existing set of branches? So we are investing in branches, we are investing in people, we are investing in process. I think if the growth comes in by these three, investing in branches, investing in people, investing in process, I think the growth rate, compared to the industry is not really way off. And since the book is very small, we started recently. And since we have expanded drastically on the affordable side with respect to branch, people, investment and process, I think this growth is in line with our overall strategy. And we don't
But
see any risk.
Sure. I think the concern stems from the fact that, even compared to your peers, your AUM growth is still in low single digits, right? Even if you slice it quarter by quarter or even annually. What is the outlook on the overall AUM growth? When do you think you could get to double-digit growth? What are we looking at in FY25 particularly? Will it be better than FY24?
I think growth on the retail book is not in single digit, it is in double digit. I think the growth on affordable is much, much higher. I think it's more than 25, 28% quarter on quarter. I think both in terms of disbursement as well as in terms of book. So going forward on the growth side, we would again look at about around 17% on the book.
17% is the overall AUM growth for FY25, is it?
Yeah.
Okay. And on credit costs, what is the outlook for FY25?
FY25 credit cost should be about around 30 bips.
Okay, all right. Mr. Koski, final question from my end. I wanted to ask you about your OPEX to average assets ratio. I think it's currently at around 0.7, 0.8%. Now, you're investing in this branch distribution network. You're also talking about investing more in technology. What should this number move up to, around 1% or?
OPEX to ATA is about 85 to 90 bips. I think it could peak to about 100 bips and then it will start slowly coming down. So it will be around 95 to 100.
Mr. Koski, apologies, just to press on that point, just to close the loop on that affordable business. There have been no sort of queries or anything from the regulator, right, on the affordable side? I'm just
not at all.
Okay.
Not at all. I just please look at PNB Housing. On the retail side, the GNPA was close to about 5.5% last March, and today we talk about it is about 1.69. If you talk about overall GNPA, it was about 8.12%, and now we are at about 1.71 as of December end. I think there has been a lot of work happening on improving the quality, and the book what we are building also is pristine, and we are in the same market. I think we are in the same industry, same segment, same market, same pricing proposition, and all the metrics are same. It's only because we have opened a lot of branches because we wanted to cover that gap of we can't take 5 years to grow the book to reach a book of about 1,500 crores because we were one of the companies to start this business late. So we need to obviously catch up. It is more a question of prioritization. So if you have to grow at 17%, obviously we would look at how best can I grow the affordable book, followed by the emerging markets book, and then the prime book. So it is a question of balancing book growth and profitability, keeping asset quality in line.
All right, Mr. Koski, we'll leave it there, sir. Thank you very much for patiently answering all those questions, and hope to speak with you soon again as we track the business. And congratulations once again on the latest round of rating upgrades, 3 out of 4, moving up to AA plus compared to AA earlier. PNB Housing up about 1% or so.